people sitting in the States writing about what's happening in Europe.
Right.
And I think it's good to kind of give the perspective directly from Europe. I mean, he said on an interview that tariff was the most beautiful word in the English language, which was wild.
Right.
But Switzerland took him seriously. And so they withdrew all of their tariffs in good faith to say, hey, we want to have trade.
And we did that unilaterally, right? Yeah. The US didn't take away the tariffs on Switzerland, but we took away the tariffs last year already. Welcome to Swiss Money Secrets, your go-to podcast for insights on offshore investing and banking from the trusted Swiss perspective. Let's get into it.
Back at it with the Swiss Money Secret podcast. Jamie Urs, excited to be here today. Big news, Switzerland, 0% inflation. What are your guys' thoughts on that coming out? I memean, especially with the SMB already quite low with their interest rates. What was kind of your reaction to seeing those numbers?
Well, I mean, I was surprised to see them this quickly, but it has been looming, I think, for a while. I mean, we had a few rate cuts and we already have a pretty low interest rate range right now. And I think the topic of negative interest rates has been around for probably like half a year or so. And some of our listeners and our audience might remember that Switzerland already had a prolonged period of time where we had negative interest rates that just ended a few years ago. So it looks like we might have to brace ourselves for another round of that.
Yeah, I agree. It was kind of a surprise, but on the other hand, also it was something that was expected at some time, and especially in April, we had a very strong Swiss franc, and that actually also did help or did lead to this outcome because imports with a strong domestic currency will become cheaper, and that will put negative pressure on inflation. So the only inflation figure that was really driving inflation higher would have been rent, but everything else was pretty low, and if you would have taken out rent, it would even be negative. But on the other hand, we still have core inflation, which is around 0.6%. So there is still a little bit of a wiggle room. But I agree with Jamie's statement that we probably will see negative interest rates coming in from the Swiss National Bank within the next 12 months at some point.
Maybe it might be interesting also for some of our clients who are listening to briefly touch upon what that means for people who work with us, because negative interest rates, I usually do those like intake conversations with people who are initially interested in starting to work with us. And that's typically something that causes a little bit of confusion and sometimes also anxiety because they're worried that they will have to pay interest rates on the Swiss francs that they hold with the Swiss banks where we manage the accounts. And I think it's worth noting that last time when we had several years of negative interest rates, none of our clients ever had to pay them. We have very close relationships with our partner banks, and we were able to negotiate good deals with every bank that we work together with. So none of our clients in the past have been affected by that. Obviously, we cannot look into the future, but we expect to handle it similarly this time, where we will talk to the various banks that we work together with and make sure that whenever possible, our clients will be exempt from this rule or like this setup of having to pay negative interest rates on the Swiss franc.
Yeah, I agree.
Yeah, that's very good, and I think Urs's point about the strong Swiss franc leads nicely into our topic today about the tariffs and kind of the ripple effects that they have created. The tariffs imposed by President Donald Trump of the United States and the ripple effects that they've had. I mean, they're pretty sweeping. And I think we should really just dive into kind of what happened. I mean, there's a lot of, I get emails constantly from clients of articles of people sitting in the States writing about what's happening in Europe.
Right.
And I think it's good to kind of give the perspective directly from Europe.
Yeah, absolutely. What I found interesting, I just came back from a trip to the East Coast, where I've been to Boston and New York City. And I was very surprised because when I left Switzerland, this tariff talk was really the talk of the town. It felt like every single person, not just economists, not just people in the financial industry, but literally every single person was talking about it. And then when I landed in the US, it seemed to be much less of like a broad topic with the general public. So that was quite an interesting anecdotal, experience for me to see that things are perceived differently from the US and Switzerland. I mean, one of our goals with this podcast is to give the Swiss perspective of things that are happening. So I think it makes sense to speak from the heart of Europe and talk a little bit about what happened, how we perceive things here in Europe, and then also what it means for people's portfolios, what it means for our investment strategies.
Yeah. Yeah, I mean, sorry.
No, I just want to say maybe we can just briefly like talk about what exactly happened. Maybe you can recap just for people who maybe haven't paid as much attention as we have on the timeline of why we're talking about it today.
Sure. I mean, the tariffs were expected to a certain extent. There was a lot of talk about that, about Liberation Day. And so people were curious to see what is it about, how much or who will be affected by how much and so on. There were certain countries, one of them was Switzerland, who was not too nervous about it because we don't take any tariffs, not any, but a very little amount. I think on average it's 1.7%. It's more on the protective side.
Well, yeah, and I would say onto that, Switzerland even last year, I believe, took away all their tariffs because, I mean, Trump was on the campaign trail chatting about tariffs. Right. I mean, he said on an interview that tariff was the most beautiful word in the English language, which was wild.
Right.
But Switzerland took him seriously, and so they withdrew all of their tariffs in good faith to say, hey, we want to have trade.
And we did that unilaterally, right? Yeah. The U.S. didn't take away the tariffs on Switzerland, but we took away the tariffs last year already.
The industrial tariffs. So there are still a little, like some tariffs on industries that Switzerland wants to protect for whatever reason. Mostly it's in the agricultural industry. But yeah, I mean, on average, it's very low. On industrial products, it's 0. And so we were expecting that we won't be affected too much. So Trump came out and said Switzerland charges 62% tariffs, which is, not even close, and wants to charge 32% on Switzerland. And so that was a shock for Switzerland, especially because for Europe, the tariffs were about 25%.
For the European Union.
European Union, sorry for that. And so around the world, there was like a state of shock. And then when Trump came out a couple of days later and said, okay, let's postpone most of the tariffs, that was a huge relief, and we are still within this 90 days where we have to see what will come out of it. In the meantime, there have been meetings, and there is a group of 15 countries that is in detailed discussion with the US to figure out how to resolve that issue. And so that's where we stand right now.
So that happened on April 2nd, the quote-unquote Liberation Day.
Right.
And I believe a week later, on April 9th, there was a pause on the tariffs on 90 days, correct?
Correct.
And the 62% is generally believed to come from the trade deficit, right? So maybe you can briefly explain what the trade deficit is for people who might not be familiar with that term?
Absolutely. I mean, the trade deficit, to explain it very briefly and easily, it's like the difference between import and exports. So if you import more goods or goods that are worth more than you export, then you have a trade deficit because you're spending more money than what you get from what you sell to foreign countries.
So the US is importing more from Switzerland than it is exporting to Switzerland.
That is correct. And at the beginning of this year, it has even ticked up a little bit because of gold exports. So what is happening, we talked about that in another episode of our weekly or monthly podcast, Economic Outlook. So there was a lot of demand coming from New York, from the US to import gold, and that gold usually comes from London. And because they have other measurements, other sizes in gold bars than we have over here in Europe, the gold goes from London to Switzerland, then will be melted, remeasured, and then it goes out to the US. And so due to that gold exports to the US, this trade deficit has even further increased.
And what I also find interesting is pharmaceuticals are a big part of what the US imports from Switzerland. So we have 2 very large, well-known pharmaceutical companies with Roche and Novartis. They operate mostly out of Basel, Switzerland. And those imports are a significant part of the trade deficit, but there has been talk of excluding pharmaceutical imports from the tariff. So that also doesn't really make a lot of sense to me if you include them in the trade. I mean, from an economic point of view, it's already very questionable to base the tariffs on the trade deficit, but then to include certain industries in the trade deficit and not include them in the tariffs, that seems very opportunistic.
And definitely, and it's also very opportunistic that they don't include the services like software and stuff, which is certainly US companies make a lot of money with that. I mean, they're like most of the software we are using here in Europe is coming from the US.
But I think, do you want to add something?
Keep going. No, I don't want to stop it. It's good stuff.
Because I think what's also interesting is to highlight how the different countries have reacted to the announcement, because some of our like European colleagues, like I believe France is one of them, and Germany, they have been quite offended by the tariffs and have also been quite loud about that. And Switzerland has taken a little bit of a more measured approach, and I think that is, for better or worse, our personality and the way we like to go about things. So we have not really reacted very confrontational. Our current president, which is Karin Keller-Sutter, our audience might remember that we don't have one president. We have like a federal council of 7 people, and then one of them is president for a year, and it just changes every year. But for this year, she is the president, and she has spoken, I believe, with the White House on the telephone. And from what we have heard, I mean, obviously none of us have been in this phone conversation, but from what we have heard, it was a fruitful conversation, and it was there was a good outcome, I guess. And what's also interesting, on top of like the more measured diplomatic approach of Switzerland, because we are very much believers in free trade, and we want to resolve this issue as quickly as possible in a way that works for both sides. Switzerland is also able to provide neutral ground for conversations between the US and China. This is news that has just come out earlier today, that there will be most likely conversations later this week between representation of the US and China, that they are going to talk about their trade dispute here.
Yeah, and I think that's the one big issue which is still remaining, is the tariffs between the US and China, and it is suffering both economies. I mean, the US has imposed 145% tariffs on Chinese goods, and China has imposed 125% tariffs on US goods, but in the meantime there has also been some relief. So for technological products, laptops, smartphones, and so on, the US has withdrawn the tariffs. So they're again very opportunistic, and the China has also withdrawn their tariffs on certain American goods, among others chips. So also very opportunistic. And I mean, it is clear that both sides want to have a resolution in this topic, but it also is a lot about like keeping one's face. So they are two very proud nations. I mean, China is there for several thousand years, and so they don't want to be put in a position of weakness by the US, and the US is like, yeah, we started that, so we can't withdraw. So it's a very difficult situation right now to resolve. But I'm also positive that also the efforts of Switzerland, because Switzerland sent out the invitations to both countries saying, come to Bern, which is Switzerland's capital, and we discussed that. I think that there will be good chances that it will be resolved, at least to a certain extent.
Yeah, I think what we have seen since the beginning of April is that there's 2 measures that have the most impact, I guess, on the US administration. Probably goes for administrations of other countries as well. And one is just the consumer sentiment. So once the general public realizes that they will have to pay for most, if not all, of the tariffs as consumers, that's going to put pressure on the US. And there we have had companies like, for example, Amazon, that said, well, we're just going to show what the additional price is going to be based on the tariffs. And that's something that is going to change public opinion on the government very quickly. And then the other thing is, of course, stock markets. I mean, we have seen stock markets really crash very severely due to those current developments, and I think that's something that we watch very closely as wealth managers.
Yeah, but they have also recovered very quickly as well. So the S&P 500, for example, is back to where it started. So and also Swiss indices and European indices from Germany and so on. So there has been a steep recovery because of the hope that it will be resolved.
Yeah, absolutely. But I think we have to look at like the Swiss and European indices separately from the US, because they have been much less negatively affected than the US indices, right? I mean,
Right.
this year we have seen European and Swiss stock markets outperform US stock markets quite severely because of all the insecurity and all the volatility that we see coming out of the US. I mean, if you don't have planning security, that's going to be very bad for stock market. So as long as things are unclear, investors are not going to like that. And the Europe and the Swiss markets have been a lot more stable for the past few months, which I think speaks into this whole topic of diversification that we just hone in over and over and over again, because we very much believe that you need to be in different markets for situations like this, that you can have more stability in your wealth, even if one market is more volatile than the other.
Yeah, absolutely. I think it's always kind of the security, or I would say the insecurity and not knowing what's coming in the future is the biggest impactor on kind of these crazy market corrections. I mean, with the tariffs coming out, and in 7 days Trump pauses the tariffs. That is like, everyone was happy about that, sure, but it's like, okay, so what is he going to do next? And this kind of volatility, I think, is also very tough for Switzerland. Why it's such a big topic for Switzerland, because Switzerland is so conservative in its approach of moving forward, explaining everything, giving people time to adjust, giving businesses. Switzerland doesn't try to spring anything on its people to a certain extent. And even though the Trump administration was saying that we're going to give tariffs, everything was a surprise. And Switzerland is way more measured in how they act. And in general, even Germany is very conservative in respect to a lot of things, is conservative in how they approach things. And so I think that insecurity obviously caused a lot of challenges. I think if these tariffs do hold up, I mean, there could be, not just in the market, but let's look at the economies as well. I mean, Germany is really kind of struggling to a certain extent. And then they have tariffs on top. It's like, man, how are we going to fix this? If this is affecting our business, it could drop us 1% in our growth as an economy per year. I mean, that's really strong effects. It could do the same thing for Switzerland. So to have that surprise and then have it taken away, and then there's, okay, so what's coming now? That's kind of a nightmare. But at the same time, what we saw is the Swiss franc shoot through the roof. And that's where that diversification played up. So when markets went down, and then there was this back and forth on the tariff to a certain extent. There was a lot of faith lost in the US dollar. Why do we want to be in the US dollar? We don't know what's going to happen. Right. And so there was this huge shift to the Swiss franc, to the euro, to the Great British pound, that really, I would say, for the people who were internationally diversified, really stabilized their portfolio picture.
Absolutely. And I mean, on one hand, we don't know what's going to happen. And then on the other hand, the US administration is very vocal about wanting to have an even weaker US dollar. Yeah. So,
yeah, I mean, there are two parts. I mean, the tariffs were definitely not helpful for the stability of the US dollar, which we have seen. But then on top of that, and that was almost missed a little bit through this whole tariff discussion. But it's also Stefan Miran is one of the advisors who said or suggested that the US could replace government debt to foreign investors with long-term government debt that pays close or almost or even 0% interest, because the debt level of the US is a huge issue as well. And so this kind of on top insecurity to what is going to happen with government debt from the US, which would be kind of a bankruptcy declaration kind of, would put a lot of pressure on the US and on the stability and also the reliability of the US.
Yeah, and I think that particular suggestion, when I read it, was like, it was mind-boggling. It's like, they're trying to come up with solutions because they're in a terrible spot and have been putting themselves, the U.S. in general, have been putting themselves in this position for 15, 16 years. I mean, even more. We can go back further to where all these things started. But like really where it escalated 15, 16 years ago, when debt didn't just take an accelerated, like a airplane taking off, it was like a rocket shooting. And I think that's the difference that we come into, is they're going to have to try to find solutions. But if you take away the interest rate on the US dollar, I mean, who wants to hold the US dollar?
Yeah.
No country wants that. The whole reason they held the US dollar was for some countries. And I think that needs to be part of the conversation too, to a certain extent, for the nuances. The US dollar, to a lot of countries around the world, is a more stable currency than their own currency.
Yeah.
But it's starting to act less and less stable as we move through this whole process.
And there you can also see the purchase of gold. I mean, a lot of emerging markets, their central banks, they are buying gold like crazy. And I mean, even at high prices, because they say we rather hold gold, even if it is at a high price, than US dollar.
Yeah, what I find hard to understand is the US, or the current administration, I guess, not the whole country, but the current administration says that they feel that other countries are taking advantage of them and that they are paying a price for having the world reserve currency. And that doesn't really make a lot of sense to me, because we have the world order that we have now because it was set up by the US, and I think the US also heavily benefits from the world order that we have, and they certainly also benefit from the fact that they have the world reserve currency. So for them to go out and complain about that and making the US less appealing as a world reserve currency is really an interesting take.
Yeah, I mean, they just want to reverse it. They want to say, okay, we still want to be the world power, like the one who has to say, but we don't want to pay for that anymore. And so I mean, to a certain extent, I get their point. I mean, they invest a lot of money into like their defense in the military to protect several countries. I mean, we saw it with Ukraine, with Europe, where Europe relied on the US way too much over the last 2 decades, if not more. And so I do see that there has to be a shift. But the issue from my perspective is that for such a shift, you need time. And you can't come in today and say, okay, tomorrow everything has to be different.
Yeah, and I think that's also just the challenge of the cycle, how do I say this, of just American politics in general. For better or worse, I'm not making a political statement here, but there's shifting powers. Right. And you're kind of going back and forth on things, and especially on monetary policy, which can create, how do I say this? They're not really back and forth on monetary policy. It's almost been one mindset for the past, until President Trump came around. And even President Trump was the same monetary policy person in the first term of his presidency, outside of the tariffs that he put on China and the trade war. But in terms of printing money being pushed into the system, it's been a one-track mind the whole way. And now trying to shift that when you're in a bad position creates absolute chaos.
I think that's also a good segue to talk about the Fed and the talks about appointing a new chair. And I think that's something from a Swiss perspective that's extremely tricky. Here in Switzerland, we hold the principle of having a neutral central bank extremely highly. So here in Switzerland, we have absolutely zero interference from politicians into who leads the central bank and how they lead the central bank, more importantly. And I think if in the US, there's going to be debates about making the Fed less independent, that's going to be a huge problem as well.
Yeah, I mean, we saw it also. It had a huge effect on the US dollar when Trump made that statement that he's thinking about letting Mr. Powell go, and also on the yield on government debts, they have increased like as a direct reaction to that. And so, I don't know, 1-2 days later, he said, look, it was a joke. I'm not going to do that. Obviously, he's independent. And so things stabilized again. But yeah, you're totally right. I mean, the independence of the central bank as a controlling organ of like a functioning government is so important.
Yeah. And I think that's something that's always been an issue in the States. There's always been political interference, whether you go back to Lyndon B. Johnson, calling up the Fed chair, and politely, not politely, making sure that things weren't going to change while he was on vacation or away on a trip. Like that is one of the challenges that the U.S. has had for a very long time. And where I think they have remained independent in the U.S. for the most part, to always have that pressure. I don't think I've ever heard of a time where the Swiss, the Swiss chair of the Swiss National Bank was reprimanded like directly or called or had his job threatened since I've been here.
No, there have been discussions or like requests being made from certain parties of how things should be handled or
Sure.
how the money should be used, but the Bundesrat, like the
Federal
council,
Council.
the federal council, always was very strong about it. Look, that's none of our business.
And that's also another point that we bring up every now and again about the Swiss National Bank only having the goal of price stability, whereas the Fed has two goals, price stability and then also unemployment. And those goals don't always perfectly align. They regularly interfere with each other, and then you have to decide which one you're going to weigh higher than the other. And I think that's, from a Swiss perspective, also very tricky.
Yeah. Yeah, I think absolutely. I think the ability to act decisively in challenging times really shows its merits. I mean, we talked about Switzerland having 0% inflation at the top of this episode. Part of that is when all of the world was going through incredibly high inflation, and still most of the world is struggling to get it under control or to their targets. Switzerland had it done within under what? 12 months, 16 months, something
it was
like
super
that.
quick.
Yeah, because they realized, hey, we have to make a move, we have to fix these things, and we went from negative interest rates to positive interest rates, and inflation came down. Part of that insecurity around the world that the Swiss franc strengthened is part of that battle, but at the same time, Switzerland is so effective at controlling their monetary stability, where a lot of countries have to hem and haw of, okay, what's my mandate? How do I look at these numbers? Which numbers am I choosing? You know, we talk about inflation because it's kind of easier to understand, but they're looking at tons of numbers. So if you have two mandates that are playing into making your decision, it makes it super challenging.
And I think something that helps as well is that the Swiss National Bank has quarterly meetings and not monthly or so. And I think like this limited amount of information from the central bank gives them also more time for things to settle down and see, okay, what are the effects, without having to explain yourself within 1 month and saying, oh, what we did last month did work or did not work for that and that reason.
Yeah, you have a bit more time to see where these movements, the lags can kind of catch up.
Right.
Yeah, absolutely. I think too, it's I would say would be good to get into kind of what is as WHVP managing U.S. clients, and like what's our perspective on where things are heading, and kind of the strategies to navigate this in general. Not making advice here, but just how do we approach this situation?
I'll let Urs speak about that just in a minute, because I'm sure you have more to say about it, especially in regards to the future. But for me, just very generally speaking, I think this time now shows again how important it is to have a long-term strategy and stick to that, even if the going gets rough. Because the biggest mistake and the biggest problem I see when I also talk to friends and people who are not professional investors is that they get too emotional and too scared, and then they just get rid of all their investments on like one bad day in April, and then the markets recover and they're not part of that. So I think for us as WHVP, we have always had this mindset of putting together a long-term strategy. And of course, sometimes you have to adapt that, you have to rebalance, you have to like check on a very regular basis what's happening. But overall, I think our portfolios have held up very well because we do have this long-term strategy that is not going to be affected by emotions that are caused by day-to-day headlines.
Yeah, definitely. I think it was Warren Buffett who once said that you shouldn't align your investment decisions on what goes on politically. So that is very important to us. I mean, obviously, political developments, they have an impact on the environment government companies act in. But then on the other hand, what we are trying to do is to focus more on the company itself, because there are so many great companies that have great leadership, and these are very smart people, way smarter than I am. And so if I can figure out what is a good company at a reasonable price, I'm going to buy it, and I'm not going to panic if there is any like political development or anything else which has a short-term impact, because on the longer term, the trends and the signs and the underlyings which made us buying this company for our clients are still intact. And as Jamie said, sometimes things change, and you have to make an adjustment and sell a position and say, okay, maybe that's not the right fit anymore. But most of the companies, they have been there for like several decades, if not even a century or more. And they have managed much worse environments than what we have today. And so this is where we try to bring in some stability and look further than what will happen within the next 3-4 months.
Yeah, and I think that's valuable on that in terms of knowing, okay, what's the long-term strategy, as Jamie mentioned, looking at, okay, what's the short-term consequences, and who are these companies? Short-term consequences, good or bad, not just, okay, I'm scared of this. It's like, no, there's potential here. And I think as you talk about the underlying financials, the underlying basis of a company, companies have been around for a long time. There are companies that have navigated multiple recessions, crazy power changes, crazy insecurity, and understanding the people, as you mentioned, who are leading these companies. Do they have the ability to navigate it? And is the company run or set up in a way to navigate that in a positive outcome? It's not, for us, it's not about the whole buying the dip at the lowest cent and, doubling up. But it is about making sure we understand what we're investing in. And so when times get rough, we don't have the greed, but we have the courage. Right. And when times are good, that we also don't have the greed to chase the momentum, but the ability to say, okay, maybe there are some other opportunities, and we can capitalize on this for our client. And I think the furthest, I think the strongest point is looking at each client individually. There's going to be totally different goals, totally different plans for their next 5, 10, 15, 20 years, what they plan with their finances. And I think treating every client individually and managing that is what is so valuable for that long-term strategy, that it's not just, hey, we have this one size fit all and it's perfect for everybody. It's like, look, no, we want to approach you and your situation to navigate this in a way that you're going to sleep better at night, that things are going to be as stable as they can be, while managing risk where we can.
Definitely. And I think on this point, proactive communication is of the essence.
Yeah.
So you have to be in contact with your clients. You have to explain what is going on. You can also overshare, but when the client reaches out, that you're here, that you're prepared to reply to his questions or her questions. And I think that makes a lot of a difference.
Yeah, absolutely. And I think proactively reaching out is also something that's important to us when big things happen. Like now, those tariff announcements, we have proactively reached out to our clients and explained our thought process and just reassure them that we are on top of things, that we are watching everything very closely, and that we have a strategy that makes sense.
Yeah, absolutely. I think that's really good conversation. Guys, thank you so much. And I look forward to recording the next episode with you.
So am I. Thank you so much.
Thanks again for joining us on this episode of the Swiss Money Secrets podcast. If you would like to learn more about WHVP and what we do, check us out on our website at whvp.ch. Or you can check us out on any of our social media handles on LinkedIn, Facebook, YouTube, or Instagram by simply searching WHVP. Have a great rest of your day.